Whenever there's conflict in the Middle East, what's the first thing you see in the headlines? It's always the price of oil, right? But that's just the surface level stuff. It's only the very first ripple. So today we're going to go way past the headlines. We're diving deep into the hidden mechanics of our global supply chain to figure out what really happens when a critical artery of world trade gets squeezed shut. Let's follow those shockwaves and see where they lead.
So let me ask you this. What if you woke up tomorrow and it wasn't a threat, not a rumor, but a reality? The Strait of Hormuz is closed. All traffic has just stopped. What would actually happen next? I'm not just talking about gas prices. I mean, everything. And listen, this isn't some far-fetched sci-fi scenario. It's a constant risk that's literally baked into the foundation of our entire modern economy.
And there it is, the Strait of Hormuz. This little strip of water connects the Persian Gulf to the rest of the world's oceans. Now, it looks pretty small on a map, but you've got to understand, this is the jugular vein of the global energy market. The countries that border the strait, they're the titans of energy. We're talking Saudi Arabia, the UAE, Iran, Qatar, and they all depend on this one single passage to get their product out to a world that needs it every single day.
To really get a handle on the impact of a shutdown, first we need to grasp just how critical and, frankly, how fragile this choke point really is. The entire global system has these single points of failure, and believe me, this is one of the biggest.
The official term for it is a geopolitical choke point, and it's a really simple idea with absolutely massive implications. Think about it. These are just a handful of narrow sea passages that funnel the vast majority of global trade. They're basically the interstate highways of the sea. So if one gets blocked, it's not just some local traffic jam. It's a full-blown global economic crisis.
And this number right here, this just perfectly illustrates the vulnerability. At its narrowest point, the actual shipping lane in the Strait of Hormuz is only 33 kilometers wide. That's about 21 miles. That tiny little gap is all that stands between the global economy and a pretty catastrophic supply shock. It's an incredibly small space to carry such a gigantic responsibility.
Now, let's talk about what's really at stake here, because the scale is just mind-boggling. We're talking about 1/5, 20% of the entire planet's daily oil consumption flowing right through that 33-kilometer gap. That adds up to about 31% of all the crude oil that travels by sea. So when huge producers like Saudi Arabia and the UAE ship their oil to the rest of us, this is the main way they do it. Okay, so if that choke point slams shut, the first, most immediate ripple effect is exactly what you'd think it is, an oil shock. The market reacts instantly, not to actual shortages, but just to the threat that supply might disappear. And boom, here's what that shock looks like in actual numbers. Looking at how markets have reacted in the past, a closure like this could send West Texas Intermediate crude, that's the US benchmark, soaring by over 30% in a single week. We're talking nearly $90 a barrel. And Brent crude, the international one, same story. It would jump 25%, hitting $91. So here's the crucial point. Prices don't just rise, they spike. And they spike violently. Just on the expectation, on the fear that supply is about to get tight. But here's where the story gets so much bigger. The intense focus on oil is understandable, but it misses all the other critical things that are suddenly cut off. And this ripple effect, it goes way beyond the gas pump and starts hitting us in places we might never expect.
Yeah, we can all connect a crisis in the Middle East to what we pay for gas. That's easy. But how does it connect to what we pay for, well, for food, for what's on your dinner table? The link might not be obvious at first, but trust me, it is direct, it is severe, and it runs right through the Strait of Hormuz. And this is how that shockwave spreads. It's not just oil. That strait is also a vital artery for liquefied natural gas, and a closure could send European gas prices through the roof. We're talking over 60%. But the one that's even more critical and gets almost no attention is urea. What's urea? It's a key ingredient in nitrogen-based fertilizer. And get this, about a third of the entire global supply flows through this one passage. You cut that off, and farming costs everywhere skyrocket, which leads directly to a potential 25% jump in global food prices. All right, now we get to the part of the story that you almost never see on the news, but it's arguably the most important reason why traffic would just grind to a halt. It's not just about the physical danger, it's about the financial risk. It's all about the ships themselves and the insurance that makes it possible for them to even operate.
More than 200 years ago, Adam Smith pointed out just how magically efficient it is to move things by sea. And that simple principle, that's what our entire modern, globalized world is built on. A single container ship today can do the work of thousands of old-school wagons. But that incredible efficiency all depends on these sea lanes, these choke points, staying open, and, this is the key part, staying insurable.
So, how does this actually work? Let's break it down. Under normal conditions, a ship has its routine insurance policy. Simple enough. But the second a conflict breaks out, insurance companies can trigger special clauses that just cancel coverage for war-related risks. All of a sudden, that ship, which is worth hundreds of millions of dollars, not to mention its cargo, is totally exposed. Now, you can get new specialized coverage for that exact risk, but the cost? It's astronomical. I mean, it's like trying to buy fire insurance when your house is already on fire. And this is what happens. It's basically a financial blockade. No company is going to risk an uninsured asset worth hundreds of millions of dollars in a hot conflict zone. The potential for a catastrophic loss is just way too high. So even if a ship could physically get through, the financial risk alone is more than enough to freeze all traffic, stranding hundreds of ships and effectively shutting the whole channel down.
So the strait is closed, physically and financially. What about the workarounds? I mean, for decades, countries in the region have known this was a risk, and they've built alternatives. But are those alternatives really a solution? The main alternative is this right here, pipelines. Saudi Arabia, for instance, has built these massive pipelines to carry oil straight over land, completely bypassing the Strait of Hormuz and ending up here at the Red Sea. From there, it can get loaded onto tankers and sent out to the world. And, on the surface, that sounds like a pretty solid plan B.
But, well, this solution just creates its own set of problems. First off, while the pipeline can move a lot of oil, it doesn't come close to covering everything that normally goes through the strait. Second, and this is more important, it moves the oil from one choke point, Hormuz, to another region with its own major security risks. As we've all seen recently, the Red Sea is extremely vulnerable to attacks from groups like the Houthi rebels. So you're basically just trading one huge risk for another. And on top of all that, all the infrastructure that supports these routes, the refineries, the storage tanks, the ports, they all remain easy targets.
So what's the bottom line? Even with all these bypasses and alternative routes running at full tilt, energy analysts figure that a long-term closure of the Strait of Hormuz could still take nearly 10% of the global oil supply completely offline. To put that into perspective for you, a drop like that would be a body blow to the global economy. We'd almost certainly be looking at a severe global recession. This quote really it captures the problem perfectly. We like to think of the global economy as this thing we can manage and control. But in reality, it's more like a gigantic ship. It's got immense momentum. And when it hits a storm of this size, a major supply shock, there is very, very little that policymakers or central banks can actually do to steer it to safety in the short run. The forces at play are just too big. Which brings us to the last and maybe the most important question. For the last 50 years or so, our entire global supply chain has been built for one thing: maximum efficiency. It's this concept called just-in-time delivery. We've squeezed out every buffer, every single redundancy, all to bring costs down. And what we've built is a system that is incredibly efficient, yes, but also incredibly fragile. The Strait of Hormuz is the perfect symbol of that trade-off. We've hedged everything for efficiency, but have we really prepared for the inevitable shocks to that very fragile system? That's the question we're all left with.